Hello, everybody, and welcome to problem 4-5 for Wiley. So as we're looking at this question here, this is not, we're given additional facts, and it's not asking us determine from these additional facts whether the presentation of the facts in the Nerwin Company income and retained earnings statement is appropriate. If the presentation is not appropriate, describe the appropriate presentation and discuss its theoretical rationale. Do not prepare a revised statement. So all we're going to be doing here is kind of looking at the additional facts and seeing what should we be doing with them. So the first thing to remind ourselves of is these are in thousands of dollars. So this 640,000 is actually 640 million as everything on this statement. But in these additional facts, these numbers are not in thousands of dollars because they're giving us these numbers here. So selling general administrative expenses for 2020 included a charge of $8,500 that was usual but infrequently occurring. So if we've got selling general and administrative SG&A, and this amount here is 66,000, what it's telling us is of that amount, 8.5 million or 8,500 was unusual, or basically was usual, but not occurring that frequently. So here, when we're looking at this in terms of how do we go through and present, would we want to include it? And we know it's going to be a part of income from continuing operations. So do we want to include it in this 66 million, or do we want to do it like this, where you would have this and then charge or other expense charge of 8,500, right? And this is getting to the same amount, but how could we determine this amount? Does this make sense? Well, one way you could look at it is you could say, well, 8,500 relative to it's 12% of the balance, right? But at the same time, when I'm looking at our total costs, or basically as a percentage of total revenue, if I took 8,500 divided by 640,000 or 640 million, it becomes a very small percentage amount. So again, if I take 640, 8,500, and if I'm showing this as a percentage, this is like about 1%. If I use cost of goods sold to see if this was material, it's also it's under 2%. So again, it would really just be a matter of preference here. But if I'm seeing though that my number for SG&A was traditionally, if this number is higher, then I might want to break this out separately. Okay, so let's go down over here to other net. So other net includes a loss on sale of equipment of 6 million. So of this 17, so that's other net. That's not net of income taxes, just other expenses and revenues. So I have one way of showing it here. So I could go other net, or I could go loss on sale of equipment of 6,000, other rev expense would be 11,000. So again, here is this material, right? And obviously this number is even smaller, than if I compared this 6,000 against sales and against cost of goods sold, for example, the amount is going to be less than, or going to be, even less than what this is. But if I'm comparing this here to my total other net items, it's a pretty significant chunk. So you may want to disclose it separately. Again, it depends on, is this material or not? How frequent is this loss on sale of equipment? Is it something that they're doing? Obviously, are they doing this all the time? So it could, again, this could go either way. So the next one here is the adjustment required for a correction of an error. And this is a result in a change of estimate. So we had your useful lives of certain assets reduced to 8 years and a catch-up adjustment is made. So if we have an adjustment for the correction of an error, we do not treat it like that. What we're going to do with that adjustment for the correction of an error, because we can change, was a result of the change in estimate. It was a change in the useful life. So I would disagree with the way that this was being handled. You would never ever want to put this here. You would never want to, adjustment required for a correction of an error. The current portion of this, you would be, I would actually be putting this into, so here's what your book says, the solution. It should not be reported in the retained earnings statement, and I agree with that because it's not an error, it's just a change in estimate. That's a very, very big difference. Changes in estimate should be handled in the current and future periods through the income statement. You cannot make catch-up adjustments. To restate the financial statements every time a change in estimate would occur would be extremely costly. So again, it shouldn't be there. It's not an error, it's a change in estimate. Therefore, it should not be showing up here as a prior period type adjustment, which is really going to the restated retained earnings. So the one other part here is that Nerwin Company disclosed earnings per common share for the net income in the notes to the financial statements. You never want to do that. You want to be showing it on the face of the financial statements. Earnings per share for a company is extremely important. And if I go over here to Tesla's stock price, one of the things you'll notice right over here is price to earnings ratio. How is the price to earnings ratio? This tells us that it's going to take 1,000 years to make up the stock price. But it's basically the earnings, basically the price to earnings is you're taking the price of the common stock, dividing it by the trailing 12 months earnings per share, and it's a very important number, and it should never be disclosed just on the financials. Earnings per share is always going to be at the bottom of the income statement. So for that last part right there, it cannot be in the notes. It needs to be in the, it basically needs to be at the bottom of the income statement. So that's really what this question is asking you to do. It's always good to kind of go through and talk these things through. I hope you found this helpful, and I will see you on the next video. Have a great one.